Here's the 30-second lesson on what legends know. Never practice nunchucks in a crowded room. Never eat chole before a road trip. Always take your shirt off before you iron it. Don't take a call near a swimming pool. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint. And now, a few episodes ago, we talked about the bank credit and which sectors it's going to. So basically, we focused on the sectors. This time around, we're going to focus on the banks themselves. What are the financials like? What is their outlook like in the future? Are we seeing some alarm bells ringing, or is their robust growth set to continue? To discuss all of this, we have with us, as always, Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Sharad.
So now, Radhika, when we talk about, the banking sector doing well, let's talk about how well. How are their profits? How have their profits been over the last quarter, the last financial year, all of that, and for both public sector banks and private banks?
Yeah, so this financial year that ended on 31st March, we saw that overall for public sector banks and private sector banks taken together, the profits exceeded 3 lakh crore. So more than rupees 3 trillion was the cumulative profit of public sector banks and public sector banks taken together. Last year, it was around 2.3 lakh crore. So now it's risen further.
This is public sector and private sector
yes,
together?
Yes, both.
Okay.
So that means that both public sector banks and private sector banks individually have profits of more than 1.5 lakh crore. But if we see whether public sector banks or private sector banks have done better, both have done well, but private sector banks have outperformed public sector banks in terms of the overall cumulative profits.
This usually is the case, right?
This usually is the case. Though there are interbank variations, but if we look cumulative profits of private sector banks vis-a-vis cumulative profits of public sector banks, both have done well. But still, private sector banks' profits have outperformed by some level as compared to public sector banks.
Okay.
And if we look individually, State Bank of India, the largest lender, has reported profit of almost 61,000 crore for the full financial year, and for the quarter also almost 21,000 crore. Now this is the biggest quarterly profit that any bank has reported till now. This is the biggest quarterly profit, and even for the full financial year also, this is one of the highest profits ever.
Right.
And HDFC comes at close second with similar 60,000 crore profit. So that is another point. Other public sector banks have also done well, like if we talk about, say, Bank of India, we talk about Punjab National Bank, they have also done well. But and the key reason for the rise in profit has been that their credit growth has been robust, something that we spoke about earlier. And because their credit growth has been robust, and they are lending a lot to retail investors, retail individuals, retail loans are rising at a very sharp pace. So therefore, the yield on advances is higher. The interest that they get on loans that they are giving to retail segment, on that the interest income is higher than the cost of deposits, and therefore the profitability has risen. So that's one of the key reasons responsible for the rise in profitability, which is the increase in interest income.
Right. So actually, this is what I was going to get to next, because lending, of course, is one of the main businesses of a bank.
Right.
So how have the loans and advances grown? Public sector banks, private sector banks, and are there particular outliers where some have seen very high growth or some have seen lower growth?
Right. So if we look at particularly the public sector bank, because they are still one of the largest lenders.
Right.
So if we look at public sector banks, the advances rate has been somewhere between 11 to 16%. So that is the credit growth rate.
That's pretty robust, because if your lower band is also double digits.
Yes. So 11 to 16%, though there are some exceptions. For example, Punjab and Sindh Bank reported a credit growth of around 6.5%. But most of the banks report higher advances rate. So that is what is powering their profitability also. And within that, again, if we see, there has been a broad-based increase in credit growth. So generally, what are the sectors? Sectors are agriculture, MSMEs, micro, small and medium enterprises,
Right.
the retail loans and corporate. So these are the four broad categories of sectors. And here we see that for most of the banks, it is the retail loan that is powering the credit growth.
This we've talked about
That
several
we've
times.
talked about, yes. So what we see in the macro numbers overall is also what is reflected in the bank's financial positions, their quarterly performance. Some of the banks are actually, they are saying that they are, trimming their exposure to corporate loan book and moving more towards high yielding retail loans, because retail loans
Right.
are high yielding. Some of the retail loans are unsecured loan that gives them higher yield. So they are moving towards that. They want to reduce their concentration risk in the case of corporate sector. So they are diversifying, because still now, even if we see, the share of the overall, the loan book, we see that around 44% of the loans is constituted for by the corporate sector.
Right.
And the rest is by retail, agriculture and MSME sector. So
That's
they
because
want
the
to,
corporates also take large loans,
large
right?
ticket loan.
Yeah.
So if we look at the discussions that they do with investors, what they want to say is that RAM, that which is retail, agriculture and MSMEs, they want to increase the share of these categories in their overall loan portfolio, which is also the case even now. So they want to do that. That is their strategy towards increasing their profitability as well.
And when we talk about the retail loans and how they can charge higher interest rates, of course, credit cards come in this.
Absolutely, yes.
And we all know how high credit card interest rates can be. So,
Yeah.
of course, they will try to move more of their business towards this, where they can charge higher interest rates. But then coming to asset quality
Right.
and the quality of the loans that they're giving out, is that improving or is it deteriorating?
It is improving. So that's another encouraging point, that alongside a sharp rise in credit growth, we have not seen till now any signs of impairment in asset quality. So asset quality continues to remain robust, and there has been a consistent decline in the gross non-performing assets ratio, which is the non-performing assets as a proportion of the advances of banks. And for some of the banks, we see that the decline is very significant. For example, for Punjab National Bank, it has declined from more than 8% to 5.7% in a span of 1 year. So that's quite an achievement. So for some of the banks, the decline in GNPA ratio is quite significant. So that's mostly the case for most of the banks. We see that the asset quality has improved, even though we've talked about that the credit growth is being powered by retail loans. As of now, the share of GNPA ratio for retail loans is the lowest.
Okay, that's good news.
Yeah. So whatever we are seeing in terms of the asset impairment, that is mostly for agriculture and MSMEs.
Which means the general public is yet not starting to default in any big way.
Yeah, not in any big ways. And that is what, if we look at, segment wise, the GNPA ratio, we see that personal loan or the retail loan segments, GNPA ratio is, the gross non-performing assets ratio is one of the lowest for almost all the banks, and whatever stress is there is also reducing. For example, for State Bank of India, agriculture loan GNPA ratio used to be more than 11% last year. Now it has come to 9.48%. So there is a decline, and the bankers are confident that going forward it's going to improve further. So GNPA ratio and GNPA, we don't see any stress building as of now.
Right. And so now, where lending is one part of the business that banks do, and quite a large part, but deposit taking is the other side of what they do, whether it's normal deposits, your salary account or current account, or even things like FDs and recurring deposits.
Yes.
So now, one way to look at the health of a bank is to see the ratio, of course, between how much credit they're giving out and how much deposits are coming in, the credit deposit ratio, CD ratio. How has that been? How has this been
so
progressing?
it's a very important metric of the liquidity of banks.
Right.
So CD ratio, or the credit deposit ratio, it is also called loan to deposit ratio.
Right.
So it is that on a base of 100 rupees deposit, how much you are giving out as loan. So that is the CD ratio, and there is no such prescriptive ratio as such, which is considered as the ideal ratio of credit to deposit ratio given out by the RBI. But generally, it is understood that somewhere between 73 to 75% is ideal. 75% is an ideal ratio.
Right.
If it starts inching towards 80%, then it's a problem to sustain this ratio unless and until the bank is able to raise its deposit base, because your deposits are getting locked up in loans, and if there is a sudden spurt in withdrawal of deposits, then there will be problem. There will be a liquidity mismatch because the bank won't be able to meet its short-term obligations. So credit to deposit ratio should be somewhere should be around 75%, and that is what banks strive to do. That they want to keep their credit to deposit ratio somewhere around 75%. Now, if we look at some of the public sector banks, we see that there is wide variation in this ratio.
Okay.
For example, if we look at Bank of Baroda, there this ratio is more than 80%. So it is 82%. It's come down by 200 basis points as compared to the previous quarter.
But
that
it's
is December.
still high.
It is still high, and that is something that the bankers are conscious about this fact. And on the other side is Punjab National Bank, where this ratio is somewhere around 71 to 73%. Again, they are comfortable because their deposit rate is also not very high. It's around 6.9%.
But that would mean that they aren't given too many loans either.
Yes, that is what. So they are saying that our deposit rate growth is only 6.9%, and we are okay because we are not giving out so many loans also. So credit deposit ratio becomes more crucial for those banks whose credit growth is very high.
Is very high, right.
So if your credit growth is not very high and your CD ratio is less than 75%, then you can manage with a lower deposit growth.
Right.
You have to mobilize higher sharp pace of deposits when your credit growth is rising, and you need to manage that credit growth because you can't stop that credit growth because it will not be good for the growth of the country. But so if you want to sustain high credit growth, then you need to have a sufficient base of deposits.
Right.
And now when we talk about deposits, there can be two kinds. One is the term deposits,
Right.
which is fixed deposit in common parlance, and what is called the low cost CASA deposits, which is current account and savings account deposits.
Right, your normal deposits that you have. Yeah.
Yeah.
So now when it comes to deposits and the credit, this also comes to the earning potential of the bank as well, right? Because for the loans that they give out, they earn interest.
Yes.
But for the deposits that they take, they have to pay interest.
Correct.
So if they are not getting enough deposits, but they're giving loans, then their future earning potential might be impacted, right?
Absolutely. So currently, if we see, so that is the metric, the net interest margin,
Yes.
which is the difference between the interest that they get on loans and the interest that they pay, which is the cost of deposits. So net interest margin till now, so it was anticipated that in the March quarter, there could be some pressure on the net interest margin, but that wasn't the case. Net interest margins for most of the banks were satisfactory, was protected, mainly because of the fact that the yield on advances rose. They got
Right.
higher interest income. So even though the cost of deposit is rising, but that was covered by the interest that they get on the loans that they are advancing.
Right.
So that is why till now there wasn't any problem. But going further, there is this concern that if you want to, have a steady credit growth, then you need to have deposits, and if you need to have deposits, then you need to pay higher interest.
Yes.
Particularly because we know that the habits of people, the investor preferences are changing. We can talk about that. And so if you want to pay, when you will pay higher interest on deposits, then the net interest margin will start compressing.
Which means that profitability will also
come down. Yeah. So that is the concern. That is the key monitorable going forward.
Right. And now sticking to this, it will likely be challenging for banks to encourage more people to
Yeah.
come and deposit money with them, because as we're seeing, people are putting money increasingly in the stock market, the options market, they're buying more gold, they're buying more real estate. Bank deposits don't seem to be the favored destination for people to put their money in. So, one, the banks will have to increase their interest rates, but even then it might be challenging.
Yeah, it is challenging, particularly in the current environment where we are seeing, as you rightly said, given the sustained bullish market, we are seeing that there is a clear switch in investors' preferences
Right.
from bank deposits towards other financial instruments. So even if we look at the National Statistical Office data on financial savings and the RBI's data on financial savings, we see that the share of bank deposits has not risen. It's actually come down, whereas slowly and gradually the share of shares and debentures and mutual funds is rising, which is also getting reflected if we look at the most timely data, which is the last month's data on assets under management of mutual funds, and that is something that we can compare with bank deposits. So if we look at in absolute level terms, the assets under management of mutual funds is still 1/4 of bank deposits, but
Right.
the fact is that it's rising at a very sharp pace. Last year it rose by more than 35%. So that is the clear indication of the investor preferences, that households are no longer just savers, they have become investors. And
Right.
even if you look at this, the most favored investor option is the systematic investment plans, where they are investing, and every month we are seeing new records being made on the inflows that are moving into systematic investment plan.
Right.
So given these conditions, it is going to be challenging to attract deposits. So banks would ideally want to have low cost deposits, which is the current account, saving account. But in order to keep the credit momentum going, they would have to attract high cost deposits, which is the term deposits.
Right.
And that would be challenging in this environment unless they increase the
Interest rates by quite a bit. So now we know that the RBI has it tried to clamp down on unsecured loans, and at the time we talked about it and it seemed like a sensible move. But now in retrospect, do you feel they might have been a little overcautious, because one, delinquency of these loans doesn't seem to be rising, not yet at least, and two, it seems like it is these loans that are driving the profitability of banks.
Yes, so this is the balance that regulator has to strike. So they have to think about these norms. They have to think about provisioning norms. You saw the latest RBI guideline on project finance,
Yes.
which is also with banks are not very happy about it, because it raises their provisioning from 0.5% to 5% on
Right.
infrastructure projects. So, but all these things are needed to avoid another round of NPA cycle. So that balance the regulator has to do. And when we talk about NPAs, they take some time in showing up, though there is a
Right.
lag. And what is also important is to look at some of the other metrics, like what is happening to slippages, what is happening to other technical loans like SMA1, SMA2, and there we do see that slippages which are for any one quarter, because payment has not been made, we do see those slippages rising in some of the sectors, though it is not alarming. So I think even if the NIM is reduced by a small amount, it should be okay. It's not necessary to have record profits every quarter or every
Right.
year. What is more important is the safety of household depositors, because households are parking their money there. So that is more important. Households are still the biggest savers, so that is more important and crucial. So I think that balance the RBI has to make.
Right, and you mentioned the provisioning norms, and we have an audience question here where they say that there seem to be two problems. The first is the lack of cutting edge technology in the banking sector, and that this seems to be true with banks outside of India too. The second issue is the regulatory environment, where changes in the regulations eat into profits. Like, say, what happened with Kotak Mahindra Bank, you stop the onboarding of new
Right.
customers, or the higher provisioning norms, which you just talked about. So, do you see that these two will ever change for India? What else can fuel growth? And will there be any consolidation in the banks, further consolidation of the banks in India?
So first about the fintech, fintechs do have that technological advantage, and they make use of algorithms to identify the credit worthiness of lenders. And banks have been using, so because they have this comparative advantage, the fintechs have those comparative advantage. Banks are using that, they're leveraging their advantage, their technological superiority to get to last mile lending, to
Right.
do credit disbursements to the underserved segment. So that is a good move. So if there is a partnership between banks and fintech, that is a good move, because banks cannot be expected to be technologically proficient. Fintechs has that advantage. They have that advantage, and it's true not only for India, elsewhere also that is true, that this
Right.
partnership or this co-lending model is developing. The other is on provisioning, which we talked about, that there is this delicate balance that the RBI or any regulator has to strike between ensuring the safety of deposits and also ensuring that credit growth also remains at a balanced pace. So sometimes the RBI does act, as you rightly mentioned, those moves were preemptive, those were too cautious moves, and banks were not very happy. But we need to see what happens to at least the project finance, because as of now it is still in the discussion phase, and banks are hopeful that they will be able to come out with some middle ground on this. But this tussle is going to remain, because we have seen a very unfavorable or unpopular episode of very high NPAs,
And that was actually very bad.
painful.
So, yeah.
And it's not that far off. In 2018, if you look at our NPAs of
11%.
public sector banks, more than 10% for public sector banks, and even now it's like for some banks it is still above 5%, 6%.
Right.
So we should not lose sight of that episode, and that is where the balance is required to be maintained. Household depositors' safety should be a prime concern for the regulator.
Right. And now we have another question, which is bank specific, like particular to one bank. They ask, give us your thoughts about the Bank of India. It's a very less talked about PSU bank, but it seems to be falling off the wagon now.
So if you look at Bank of India's particularly, we have access to their quarterly balance sheet numbers and annual numbers. On some metrics, Bank of India is doing okay. For example, their capital position is fine. It's above 16%, which is above the regulatory threshold. So that is fine. NPAs have declined significantly as compared to last year. The main problem is the credit deposit ratio.
Right.
Which we've talked about, that there are some banks for which the credit deposit ratio is inching towards 80% mark, or even surpassed the 80% mark. There is a problem, and RBI has very openly talked about this, that high CD ratio is a problem, and there you need to control the exuberance in lending. So for Bank of India also, the CD ratio is inching towards 80%, and also the other monitorable is their net interest margin, which has actually declined from last year.
Okay.
So these two things are the key monitorables that they need to be managed, particularly because if we need to sustain high credit growth, then deposit mobilization is needed, and Bank of India seems to be one of the bank where deposits are needed in order to sustain the satisfactory credit growth, because their CD ratio is high and their net interest margin seems to have declined from last year.
Right. So there you go. That's a wrap for the entire banking sector. Overall, things are looking quite good in that profitability has hit a record high. The amount of profits that private and public sector banks together have earned is at a record high, and things are looking good in terms of credit growth as well. There are more loans going out. A lot of these loans now, banks are trying to push them towards towards the retail category where they can earn higher interest. The defaults of these loans, those don't seem to be high or at an alarming level. So that's also a good thing, which means that asset quality is also improving. That's a good sign. But you know how on a sunny day, in the distance, you see these storm clouds approaching. They're still in the distance, but they are there. And this is to do with some of the banks having a high credit to deposit ratio, which means that they're giving a lot more credit compared to the deposits that they have. and now this is the problem because it affects their future profitability. In the future, they might not be able to earn as high profits, and this of course will affect their finances. But overall, things still seem kind of stable right now. And on that note, that's all we have for you. Thank you so much for watching.